Well, good afternoon, everybody. It's Close of Business Tuesday, and this is going to be epic because we got some home cooking today. To kick off the second half of 2021, we've asked our crack research team to join us. We got the whole family here today. Well, not entirely the whole family, but some of our key thinkers. And we've asked each one to come in and join us and talk a little bit about key observation from the first half, key thought or focus area for the second half. These guys are so brainy. They've gone away and done a bunch of analysis and may even share some slides with us as they go through this. But first of all, on behalf of all of TPH, I'm applauding the research team. It's great to have you guys. We love you, and we really appreciate the work you do every day. So I'm going to introduce people as we go. This looks like the Brady Bunch research right now on my screen. I got everybody. It's fantastic. But before we get into that, guys, Mike Bradley, tell us what's going on. Apparently, OPEC had a party. Somebody forgot to bring the pizza. Nobody brought the drinks. Everybody was cranky. What's going on in the Mideast?
Yeah, Maynard, it was a big party bust last Thursday and Friday. OPEC was supposed to get together for their monthly meeting. Everything seemed to be in hand. They were looking to raise production by about 400,000 barrels through the course of the year for about 2 million barrels of increased production, and that went awry. And the reason why is UAE had a lot of things that they wanted delivered, and it's been sort of festering under the sheets for a while, and that was essentially a couple things. One, they wanted their production benchmark raised by about 500,000 barrels, and that's something that's been festering since the original deal back in April. Right now, they're around 2.8 million barrels, and they wanted their production closer to 3.6, 3.7. Their quota right now is around 3.2. The second thing is that Saudi and Russia wanted to push the extension of their deal from April 22 all the way back to year-end 22, and UAE was having nothing of that. And the reason why is this, is that UAE has spent a lot of money over the last couple of years in spare capacity, and right now their spare capacity was around 4.2 million, and most people have them around 5 million. And why that's important is because if you look at most people in OPEC right now, their spare capacity or their utilization is around 70 to 75%. And if you look at where UAE is, it's down into 60 to 65%. So I think they do have a valid argument to be made that their production should be 500,000 barrels higher. And the reason why they wanted higher is because, as you recall, back in late last year, they were talking about creating a market for Murban crude oil. They need a lot of liquidity in that market. They need to get their production up, for others to join that market and at some point wean them away from OPEC in general. So that all came to a head here this week. And, so the question is where do we go? And I think where we do go is that the market is massively undersupplied. If nothing happens, you're going to have the market being 2.5 to 3 million undersupplied in Q3. Prices are going to go higher. Inventories are going to drain. That is not good for the world. And so I think at some point here, we're going to probably have some sort of deal. The interesting thing is the UAE was going to sign on to the 400,000 barrel a day increase. And so it's not that they don't want that. They do want to increase. And so we're going to probably have at some point there's going to be an agreement. Now, what's interesting is the Biden White House is now getting interested in where oil prices are going. And they basically said that they want sort of reliable and affordable, oil pricing. That didn't really matter when they pulled the permits and when they, basically decided to go ahead and, kick Keystone down the road. So, I think what we're learning now is that things are a lot tighter than expected. And even if you bring Iran barrels back on, even if you bring in OPEC spare capacity, next year we're going to be in a market where we're probably going to only have 2.5, 3.5, 4 million barrels of spare capacity. That's going to mean longer dated crude prices are going to be higher, and people got to get used to that. So that's kind of where we are in right now. I think most people got used to OPEC basically having an agreement in hand, passing a deal, and moving on. That just hasn't been the case this time around, and so the market is really concerning. And what is that leading to? That's not leading to higher oil prices. That's leading to lower oil prices right now because people are concerned about the longer term impact, and that's leading to what we saw in energy equities today. They really got slaughtered today because of the uncertainty of OPEC. I think we're going to be just fine. Fundamentals look good. We're going to have an agreement at some point. We've run a long way, and so I'm not panicking. I'm buying into the situation, not selling into the situation.
So, Mike, when could it clear up? What's the market's best guess? What's your best guess?
My guess is it's probably going to be within weeks. I think there's going to be pressure from Russia. I think Saudi's going to, apply pressure, and I think the U.S. is going to apply pressure to the UAE to come to some sort of a deal here. So they're saying that they're not meeting right now. The meetings have been adjourned and they're not talking. I disagree with it. I think there's probably diplomatic issues going behind the scenes. So I'd be surprised in the next 2 weeks if we don't have some sort of a deal.
Okay, awesome. Okay, holy smokes! I mentioned it up front. We've got a unbelievable assemblage of our research minds, and so let me I'll just tell you who we've got really quickly. We've got Matt Portillo, our head of research. Matt's going to talk about upstream as well as automobiles. We've got George O'Leary, who does energy services and equipment and also solar. We've got Matt Taylor. Matt's up in Calgary, does the macro, and in particular focuses on natural gas liquids, ethane, propane, etc. We got Colton Bean. He's in Denver. He does infrastructure, but what's fascinating is infrastructure at TPH now means all the usual stuff you were used to, plus renewables related infrastructure. We got Matthew Blair. Matthew's chemicals, refining, and also now has things like renewable natural gas, renewable diesel, etc. Matt Murphy's also up in Calgary. He's got the macro, as in good old-fashioned oil and gas. So I think I've hit everybody. But look, guys, I said it up front. All of us at TPH are so proud of you guys and appreciate all the work you do constantly to keep us all as smart as possible. So I can't reiterate that enough. But let me get out of the way and, Matt, ask you to do two things: your piece plus anything you would tell our audience about the research team.
Thanks, Maynard. We thought this would be a great opportunity to really get in front of investors, clients, and the industry folks that watch COBT and really talk about some of the trends we've seen in the first half of the year and some of the things that the research team is working on in the back half of the year. And from a big picture perspective, as you can see, really everyone on research is wearing multiple hats at this point. So as we still continue to work on the macro side of things from a traditional energy coverage standpoint, as well as our company-specific coverage, we've also branched out into really a lot of new interesting different parts of research that really cover the broader energy spectrum as a whole. And so I'll kick it off here with talking about two different topics that the Upstream team currently covers. One is our outlook for the Upstream universe heading into 2022, as well as how we're thinking about the automotive sector and the implications as we think about electrification trends moving forward. So I just wanted to share a couple of slides with you that will cover a couple of trends we've seen year to date. These are really important trends, and one of the reasons that we came out quite constructive on both GM and Ford from a stock standpoint is that we've seen some really interesting changes to the way that these business models are being run. So one thing you can see on the top left-hand side of the chart is that the industry, unfortunately, due to COVID shutdown-related production issues in 2020 and now semi-shortage-related issues in 2021, has cut back pretty significantly on production in the U.S. and globally. And what that's effectively done is it's drawn down inventory levels at the dealership level, which has two implications for the sector as a whole. One, it's allowing auto manufacturers to push pricing, which means less incentives to consumers, and that's actually expanding margins for the industry as a whole. So we've seen record profit margins over the last few quarters for a lot of the OEMs that we do cover. And two, it's actually pushing up the used car pricing as well, which has positive implications for the financial businesses that these companies do also participate in. So as you can see on the left-hand side of the chart, we've seen a dramatic drop-off in inventory at the dealership side of things. That should bode well for 2022 as we think about the implications for production ramping at the OEM level. That ultimately means we'll see positive rates of change on supply as we head into next year and higher sales. At the same time, consumer demand in the U.S. has remained extremely robust, and that's been a positive implication as well, which we do track both the U.S. and global trends from that standpoint. On the right-hand side of the chart, just wanted to cover the used car market. It is quite shocking. If anyone's actually gone out and tried to market their used car over the last year or two, you probably have realized that if you bought something in the last year or two, you're actually able to sell your used car pretty much for the same price you bought it for. And that's been a big benefit for the OEMs in regards to their financing business. So those two trends, I think, are going to continue to be positive trends for auto manufacturers in the back half of this year. And the big sea change we've seen from the industry is similar to what we've seen in the upstream space, which is value over volume. Producers are no longer really interested in chasing just market share as a whole. They're really focused on really generating higher margins moving forward. And I think what that's ultimately going to mean is that you're going to see lower inventory levels going forward. You're going to see auto manufacturers trying to deliver autos just in time and really tailoring it to consumer demands as you start to see this connectivity with the consumer increase. On the bottom page of slide 1 is really just an interesting chart of looking at electrification trends for EVs globally. And I know a lot of our clients that we speak to do focus primarily on the US, but it is a global auto market. And so as we spend time looking at trends both from Europe to China to the US, we do see a pretty big divergence in consumer demand as we think about electrification trends. A lot of this is driven by policy, but a big part of this is also driven by the autos that are being sold in the market today. And we do expect a pretty significant sea change in the US as we step into 22 and 23, as we start to see large SUVs and trucks hit the market. But as you can see, Germany's leading the pack out of Europe with 22% of year-to-date sales essentially falling in the EV category. So that's electric vehicles, battery electric vehicles plus plug-in hybrid electric vehicles. You're seeing strong trends out of France and the UK. And then China is the really important market to watch because China is the largest automotive market in the world. We are seeing total sales for automotive vehicles actually already mirror 2019. So there's a strong recovery underway. But at the same time, we're seeing a strong push from the Chinese government to electrify the auto fleet. And given the importance on the gasoline trends, that is something that's important to watch. As you can see in the bottom right-hand side of the chart, the U.S. is lagging a bit here from an electrification standpoint. But as I mentioned previously, a lot of the high-selling, high-volume vehicles have just not hit the market yet, and we will see those in 22 and 23. And as we think about the broader trends moving forward, the U.S. is going to start to play some catch-up here over the next year or two. Moving to the next slide, really wanted to cover just a little bit of color on the battery side of things. This is a very key component of electrification. And as we've talked about previously in some of the segments, getting down to that $100 per kilowatt hour is really an important component of reaching ICE parity as we think about BEV to ICE parity moving forward. Unfortunately, in 2021, we think when we start to see discussions around this topic, we're going to start to see the cost trends level out here. That's actually a big break from the trends we've seen over the last decade. So just for some context, in 2010, batteries cost north of $1,000 per kilowatt hour. Those have been on a very steep decline over the last decade. That's been a big shift in the cathode chemistry that's been driving that. Unfortunately for the manufacturers themselves, a run in metals pricing, as we highlight on the right-hand side of this chart, is stymieing some of the changes we're seeing on the cathode moving forward. And that is likely to cause the battery cost this year to come out pretty flat to what we saw in 2020. So for the first time in the past decade, we're going to see a bit of a plateau here in the near term. That being said, we do see line of sight to a shift in the anode moving forward, potentially shifting to an anode rich battery setup, which ultimately could lower costs further. And then ultimately solid state batteries could be the grand solution for the industry over time. So it's something that we'll continue to monitor and continue to watch. But battery costs are a really important component of thinking about consumer adoption trends and how this could ultimately impact the oil and gas market. Lastly, just wanted to talk a little bit about 2021. It's been a great year for the upstream sector. We've been quite constructive on the space as a whole. Really fascinating couple things that have emerged. One, the divergence in industry cost structure has really flattened out. So if you look at the top of this chart 2-3 years ago, we would have seen a wide spread in break-even economics across our covered universe. The high-cost part of the curve would have been above $50 per barrel on WTI. The low-cost part of the curve would have been in that $35 to $40 a barrel range. Now what we've seen as operators have slowed down, as they've allowed base declines to moderate, and as they've cut back on their debt load, the cost structure has really flattened out. So as we talk to investors in the space as a whole, there's a lot less differentiation in the equities, But as you've seen across the board, that also means that the sector as a whole is also a lot healthier. And it generally means the upstream space in general is a lot more resilient than we've seen in times past. The bottom two parts of the chart are really the key focus for us as we head into 2022. And this is really just about free cash flow generation. One of the biggest benefits we've seen to the industry, essentially focusing on maintenance capital, essentially defocusing their discussions around growth, and really focusing on shareholder returns, is that massive increase in the free cash flow yield. And as you can see, the sector as a whole on a free cash flow to EV or free cash flow to equity basis is now approaching a mid-teens yield. And that, quite frankly, we don't think is sustainable, because a lot of that cash after 2021, and 2021 is really about balance sheet repair. As you can see on the right-hand side of the chart, the leverage metrics in some cases are essentially approaching zero. But for the vast majority of our coverage, leverage is dropping below 1x. That's going to be a point where you're going to see a massive inflection in shareholder returns. And I think you're going to see a lot more companies starting to adopt return of capital strategies that mirror some of the industry leaders like Devon, like Pioneer, and others that have moved first on that discussion. I think you're going to see the industry as a whole really adopt and embrace that return of capital strategy, which quite frankly has been very well received from investors across the board. So as we think about the space, even though the macro fundamentals have aligned and have moved into a position where the curve is quite healthy, I think when we think about the equities specifically, given where they're trading at today relative to the S&P, and as we think about the broader space as a whole, the shift in the capital return strategy is going to be a big focus for clients as we head into next year, which we think will be a big positive for the space in general. And we do see equity performance continuing to move up and to the right from here.
So one question for you, Matt. The hybrid market, and I know your figures on electric vehicles included hybrids. It seems like, maybe I'm imagining it, but hybrids are getting a new look, some new momentum. You know, it's a nice combination of both worlds. Anything you'd add on that from your seat?
Yeah, we're seeing in a lot of cases the adoption on plug-in hybrid electric vehicles and battery electric vehicles in a lot of these countries are pretty similar. And the reason that plug-in hybrid electric vehicles, in particular in the U.S., may ultimately be a positive solution for the consumer is that for most U.S. drivers, typically you drive less than 35 miles a day. And with the improvements in the battery technology, the range for one charge on a plug-in hybrid electric is approaching 25 miles at the moment. And over the next 2 years, given the expansion of energy density, we think that will approach 50 miles. And so you could actually have a situation where plug-in hybrid electric vehicles allow you to charge at home and drive that short mile distance you do every day, but still have the optionality if you want to take a long road trip in the US to take these longer trips with a gasoline engine attached to it. So plug-in hybrid electrics may ultimately be a great solution for the US consumer. There's not a lot of optionality right there. There's not a lot of optionality in the market at the moment. But as we look forward over the next 2 to 3 years, the sheer volume of cars being introduced into the market that are going to address plug-in hybrids and that are going to address battery electrics, I think are really going to allow the consumer to make that choice. And we do expect to see a pretty significant shift in the trends on adoption rates as we step into 22 and 23.
I'll tell you a funny story, Matt. Over the 4th, I was in Galveston. I went with my 16-year-old. We walked into the golf cart store. And the most exotic thing in the golf cart market is if you can find one that runs on this thing called gasoline, because it can go anywhere and you don't have to recharge it. So apparently gas golf carts are selling for like $17,000 if you can find one. So just another quirky comment from today's world. So thank you, Matt, and thank you for all the leadership of the team doing all this great new stuff. Let's jump around. Let's go north. Let's go to Calgary. We've got both Matts up there. And so Matt Murphy, why don't we go to you for the macro, and then Matthew Taylor will get you in here too. But take it away, Matt.
Yeah, thanks, Maynard. So I'll start off by sharing a few slides going through the oil and gas macro backdrops to build a little bit on some of the, I guess, the history getting to where we are today, aligning with some of the comments that Mike addressed. But I'll kick things off just on the oil side. As a starting point, I'd say we entered the year fairly constructive on the setup for a few reasons. First, we'd not seen inventories as materially divergent from historical norms, as we show here on the slides, despite the headwinds that 2020 presented, with recent data suggesting we've closed the gap essentially by the mid-year point for crude oil, while products have diverged a little bit from norms of late, ahead of anticipated higher demand in the summer driving and likely flying season as well. But still a significant closing of the inventory gap since last year. And alongside that, a core underlying tenet of the recovery and significant rally in crude pricing we've seen has been the capital discipline out of the U.S. as the year has progressed, as Matt had mentioned, which has better enabled the balancing of the market from OPEC Plus as demand has recovered and global spare capacity has been worked off. And as we look into the back half of the year, there are obviously some question marks now following the recent disagreement from within OPEC Plus on the path forward for 2022, as Mike mentioned. But barring a breakdown in OPEC Plus, we do see the setup for healthy inventory draws for both crude and products, particularly acute in the third quarter as crude runs rise, owing to a continued recovery in demand. Looking a little bit further out, just given the spotlight that's now been placed on 2022, given this weekend's OPEC Plus festivities, I'd just say with U.S. growth expected to reemerge alongside likely incremental Iranian supplies and a healthy amount of spare capacity from the core OPEC Plus members that Mike had mentioned, we'd seen the market balanced with some relative ease, i.e. one that we didn't see driving significant upside from the forward curve in the $70 Brent or so range. Again, with now some question marks on how OPEC Plus may look to balance the picture next year. Shifting gears to the gas side, for gas, I'd say we came into the year relatively constructive on the outlook as well. And it's been a somewhat similar picture to the global crude market in that U.S. discipline has been a key feature of the improving backdrop for Henry Hub pricing as years progressed alongside fairly tight global fundamentals. And so in addition to the discipline I mentioned, a key to what's gone on in the lower 48 has been a fairly constructive global backdrop, as has been seen in the European storage picture that we highlight here, coming out of a cold winter in Asia, which suggests, as we show in the top right, a continued fairly significant call on U.S. LNG exports to even attempt at filling caverns ahead of winter, let alone be relatively well supplied, which has contributed to a fairly tight lower 48 market coming into the year. Despite some of the challenges that we'd seen in the 2020 market, as we see here in U.S. LNG exports. Now with a tight global market, a disciplined U.S. supply picture, both on the associated side as well as the dry gas sides this year, we'd seen the call on demand destruction really via power generation, via higher prices, frankly, to keep the market balanced. And we've certainly seen a significant call on gas recently in power generation, the heat wave that we saw in the Pacific Northwest, as well as up here in Calgary, and then some in the past 2 weeks as summer pricing rallied north of 380 NM just the other day, and winter nearly reaching the $4 a million cubic feet level. From here, as we look into the back half of the year, I'd say we see the forward curve as reasonably fairly valued on a normal weather basis, as we expect supply to begin to ramp into year end. But if hotter weather arrives, as we just saw last week, it could continue to keep some pressure, upward pricing momentum on price into the winter months, with the Canadian import picture, something that is often sort of ignored in the lower 48 picture. Likely driving a pretty high call on gas in our side of the continent as well to keep that lower 48 market fairly tight. So overall, I'd say we're pretty constructive coming into the year, broadly on both the oil and gas side, and things have played out quite well according to those views.
So Matt, at one point I thought we were hearing a little bit about coal switching. Maybe I dreamed that. I can't remember the context, but is there any of that going on? What would you tell us there?
Yeah, so that was really the key to balance the market that I talked about in these summer months here, where you have fairly flat supply on the U.S. side, and a pretty serious call on exports, both on the Mexico side as well as to the broader global market in Asia and Europe. And so really the balance to keep U.S. storage full going into or at a healthy level, I should say, going into the winter months, was really gas to coal switching. We used to talk about coal to gas switching as coal plants were retired. But gas to coal switching was really a feature of how we anticipated gas balancing in these summer months, and we have seen that pick up of late. So in the past few weeks, as the heat picked up, particularly as I mentioned in the Pacific Northwest, we'd seen some incremental coal burn, but really struggling to take some of that market share away from gas, as it was a fairly tight market. But in the past few days, over the July 4th long weekend, we did see coal stealing a little bit of market share as the calendar month turned into July, despite a broad shift away from that, obviously, as a power source.
Okay, well, look, thanks, Matt. Let's go to our other Canadian Matt Taylor. And Matt, as you jump into natural gas liquids, also please feel free to comment on the Stanley Cup. I've gotten a lot of comments out of our Calgary office, so please start by telling us how you see it shaping up.
What a great question to start my segment. Habs are down 3-1. We are not out of the count quite yet, although I saw the Tampa Mayor was calling for the Lightning to lose so they could win at home, so we took offense to that. So we need to have 3 more wins here, and then we'll get it across the goal line.
Okay, so you're saying it's possible.
It's possible. We're not ruling it out. It could be a second half of the year outcome here.
Okay.
So natural gas liquids has been a hot topic. It's usually the underloved commodity stream. So the reason investors have been watching these particular pieces of the commodity value chain is ethane has passed the 30 cent per gallon mark, the highest for some time, and then propane has crossed the mythical $1 per gallon mark as well. So these are really the 2 most important in our minds, as they make up about 70% of the NGL barrel. And if we're being honest and we're getting into the winter here and some of us use propane to heat our house, we should be very interested in these following comments. Propane, in our opinion, is the most interesting right now, but there are some key points to watch out for ethane. So, we'll start with ethane here. Ethane is sitting, like I said, at an eye-popping 30 cents a gallon. And it's drove some investor interest. But I think what's more interesting here is the fact that natural gas is trading at $3.60 an MMBTU. And the reason that's important, as you'll see on these slides here, starting in the top left, is the US ethane market is oversupplied. So on the top left, you'll see the most recent data shows us inventory levels are about 40% higher than normal, despite demand, like you're seeing there in the top right, where exports are steadily tracking higher. So we're seeing the same demand characteristics also in domestic demand. It's not shown here, but strong ethylene pricing has pushed demand higher. So you've got strong domestic demand, higher exports. So what's the crux of the issue here? The issue here is production, and you'll see that on the bottom left of this slide here, where there's a large amount of ethane that's currently rejected, meaning it's left in the gas stream and sold as natural gas. And so you're seeing there over 900,000 barrels a day, which could be extracted should there be adequate economic incentive to do so. And that's really the final point here on ethane is on that bottom right slide is the incentive there today? Well, the past 18 months, ethane has only traded at a modest premium to natural gas, which the market is telling you that there's not enough demand in the system to pull those prices higher. So in order for that to materially widen out, we need to see more demand. And so if we put all the demand factors together, both cracking demand and new exports over the next 2 years, we have about 360,000 barrels a day. So you'll see that falls well short of the amount of ethane being rejected in the gas stream today. So if you were to boil down ethane and our view on ethane, we see it being structurally oversupplied with the amount of ethane being rejected in the gas stream, like I said, well in excess of new demand coming online. So where pricing should track is generally in line with natural gas pricing with some short-term disconnects. And so the reason you need to care about ethane, like I said, is it's about 40% of the barrel. So moving on to propane, the key message on this next slide is that the U.S. market is actually the complete or the total inverse of what's happening in ethane. We're totally undersupplied in propane. And so our view is that we expect strong pricing to continue in the summer and then get higher and even more volatile in the winter. And so what's happening in the propane market, you'll see in the top left, is that days of supply are 35% lower than normal. So any of you propane nerds out there might know what days of supply means, but most of you probably don't. What that basically is telling you is how much inventory we have versus total demand. So in a normal summer, at about halfway through the summer months, we should have about a month and a half of supply. And you're seeing there is we're well short of that. We're less than a month. And so, what does that mean? What it means is that if we don't have pricing high enough to choke off exports, meaning leave some domestic supply in the market to refill inventories, we might be headed for an inventory crisis this winter. So what the top right is showing you is how resilient demand has been, both on the domestic front with colder than normal temperatures, and then also higher than normal exports. And the reason for that is some really strong Asian pricing. And then the bottom left chart, what that's telling you is we've had a lot of demand, but where's supply been? And as the upstream community and also here at TPH, as we've been messaging, is there's really not any incentive from public investors and others to put more capital to work at the drill bit. And so production, as you can see there, is basically flatlined for most of the year. And so then the real question is, how undersupplied are we heading into the winter? And I think that's what's the most important here, which is the bottom right chart, is you're seeing relative pricing the strongest it's been for a number of years. And so for us, the thesis here is, like I said, we're going to need to see stronger pricing here to keep propane, to refill it so that we're not having to enter crisis mode. So if you recall, we did enter crisis mode when Asian pricing went bananas, and then you saw US domestic pricing back here in February. So that could be a very likely outcome here if we don't start refilling inventory. So if I were to leave you with two key messages on natural gas liquids, is ethane, in our view, appears oversupplied, should track close to natural gas pricing, whereas propane is undersupplied, and we should see some relatively strong pricing heading into this winter and even in the medium term into next year.
Okay, that's great. Thanks so much, Matt. All right. Well, maybe we're sort of coming south. Let's stop in Denver and see our friend Colton Bean. I mentioned Colton is in our infrastructure area, but that means classic infrastructure, like we've all thought about through the years, but also renewable infrastructure. So, Colton, let's go to you in Denver.
Thanks, Maynard. So I'll be hitting on both the midstream sectors you mentioned and also renewable power. So great. So starting off on midstream, I think the sector has had a really incredible start to the year. We're up roughly 40% year to date. And I think that's driven by a combination of, one, increased throughput optimism, two, improving NGL margins, as Matt just mentioned. And then, really the third and a little bit more of an exogenous factor is the Q1 earnings windfall that we saw from Winter Storm Uri. So if you look at the performance within the group there in the bottom left, there's been a pronounced skew to both U.S. operators and higher beta, given the rate of change that we saw versus 2020. We're also starting to see a widening gap between large cap C Corps and MLPs as partnership fund flows continue to lag. You'll notice, particularly Canadian large caps have materially lagged year to date, given some of their more defensive characteristics. Yeah, as we pass the mid-year mark, a few themes stand out for the back half of the year and moving into 2022. We also have a nod to 2030 up there that we'll touch on at the end. But first, on volumes, that optimism is giving way to rig count. So what we mean by that is earlier this year, there was a willingness to accept that rising crude prices would inevitably attract production growth. Now, here at the midway point, we've seen an uptick in skepticism on basins ex-Permian as public operators have largely held the line in capital spending, which has translated to increased hesitance to underwrite volume growth for public investors outside of specifically the Permian. The second would be on the NGL price trade. We just heard from Matt, how well supported this trade is by fundamentals. At a high level, we expect the arb between domestic and global pricing to close to support domestic inventories into the winter. The issue for midstream equities is that fundamentals look great for operators that are exposed to those commodity margins, but they're also very well understood by the market. So that raises the hurdle for outperformance as we move into the back half of the year. And then finally, companies are going to face increasing pressure to update capital allocation strategies, given balance sheets have improved quite a bit, certainly versus last year. And equities have appreciated, in some cases, approaching 100% just year to date. So while there isn't a one-size-fits-all solution, there continues to be a preference for lower leverage and limited capital spending on legacy midstream. Frankly, we don't see that many areas of the supply chain within traditional midstream that need material investment. And I think we'll continue to see investments in processing and gathering, occasionally a fractionation build out, but by and large, the large long-haul trunk line infrastructure is in place. We do expect investment in the energy transition landscape to be viewed with a more forgiving lens. So I think we've seen a bit of hesitance on the corporate side in terms of being the first out of the gate, to make a splashy renewable investment. What's interesting is there's a bit of a dichotomy with public investors who are actually looking for a midstream company, trying to see who can navigate the energy transition, who is looking towards that, investing more aggressively. So all that to say that we do think you'll probably start to see some pilot programs. You'll start to see investment likely in the hundreds of millions, not certainly in the $1 billion category. But we do think you'll see increasing investment in the energy transition landscape, as frankly public investors are looking for it. Last one within that arena, carbon capture has really dominated conversations, given the overlap with existing midstream skill sets, and again, the potential scale of investments. So kind of back to that point on millions versus billions, carbon capture, as you're looking at full system build out, is going to be measured in the 1, 2, 3 billion range. And so I do think there's a thought process out there that could be really the next leg of material investment for midstream players. So with that, we'll shift over to the renewable power side of the infrastructure spectrum. Year-to-date performance here has been quite a bit more mixed. So we started off, truthfully, we closed out 2020 with a phenomenal year. Came into January riding high. Actually, we're hitting all-time highs for the equities to close out January. That preceded a very sharp sell-off. The reflation trade took hold and concerns around the stretch valuations mounted. So despite the valuation reset, the backdrop for renewable power has remained relatively consistent. We're continuing to see PPAs announced from both corporate players, from utilities alike. As we look into the back half of the year, one, we do think you'll probably see some of that bipartisan policy support that's out there manifest in extensions of the existing tax credits, so both the production tax credit on the wind side, investment tax credit on solar. You think you could see material long-term extensions there. And there's also debate around the implementation of the federal clean energy standard, which that would serve to really accelerate deployment of renewable power really across the nation. Second, we've also seen a flurry of announcements around auctions and permitting of East Coast offshore wind installations. So second half is likely to bring more project announcements, capital totals, timelines. Given the increased scale versus onshore, where you're investing, maybe in the $200, $300, $400 million scale, offshore often in the multi-billion range, these projects have attracted European utilities and also traditional oil majors, ramping up competition in that space. Finally, on the equity front, as we move beyond what we probably characterize as the euphoria stage that we hit the back half of 2020 and early 2021. We are expecting increased scrutiny on growth targets, so that should accrue to the benefit of operators with clearly delineated backlogs, versus just a general capacity or an investment target. It's honestly not dissimilar to what we saw in midstream 5 to 6 years ago. We're also starting to see a pretty dramatic escalation in third-party M&A valuations, so that's widened the gap between development economics and M&A. And it's raised questions about the viability of acquisition-driven growth. So we do think there will be a keen focus on domestic development runway and success in upcoming international procurement auctions to really be the drivers of equity performance through the back half of the year.
That's awesome, Colton. Just one question before we go to George. When you get questions on renewable power companies and macro issues, what's the number one thing investors tend to call you and ask about? Like, is it a regulatory thing? Is it a tax thing? Is it a specific market thing? Is it a permitting thing? Like, what is the key question you're often getting?
It's always returns. It's returns by 80-90%, and everything else is a distant second. So I think there is a broad understanding that this is probably a 20 plus, in some cases, it could be a 40 plus year investment runway. And as people have kind of worked through the math of what it would take to transition us away from a carbon-based power system into one that's renewables oriented, it's an incredible amount of investment. It's an incredible amount of time. So the capital opportunities are there. I think the question is, how much competition do you have, and what does that do to the return profile in the interim? So at present, the economics can still make sense. Certainly right now in an environment where we've got incredibly low interest rates, equity expectations for the renewable complex are a little bit lower. Probably a separate conversation, but I think that factors into the terminal value discussion too, where investors that are looking across the renewable landscape are willing to underwrite pretty material terminal value versus what we're occasionally seeing in traditional energy. It's a different conversation. So it really does come down to returns and just a bit of a fear on what competition will do to those over time.
Well, let's jump now. We're back in Houston now. George O'Leary, affectionately known around here as Go Leary. Go. What do you got on your mind today? You've got a big space because you have the classic, what we would have called oilfield service, that's now energy services and equipment plus solar. So let it rip. What do you got?
Yeah, it's a broad, all-encompassing space, and I'll only add a minor correction. Most of the guys around here call me Bro Leary and not Go Leary. So that's the affectionate name.
You're like a Geico commercial, Brohim.
Right,
Take it away, Brohim.
I'll take what I can get. So we'll start with oilfield services or energy services and equipment, as we're now calling it, which makes a lot of sense to me. So the ESC equities were really on a tear from the April 20th timeframe through early June. It's been a good year overall for OFS equities, albeit on relatively light volumes. But that period, April through June, was particularly strong. And we've just seen some air let out of the tires in recent weeks with quite a bit of the bloodletting in the space today, amid a weak energy tape and just given very light buy volumes out in the market. So today was particularly ugly, but the last few weeks have been relatively painful. We're actually nervous about the group heading into the impending earnings season, and we do remain a bit tactically cautious despite thinking some real buying opportunities will emerge in the back half, given a relatively rosy activity outlook on both the U.S. and international fronts. But at the moment, from a fundamental standpoint, what surprised us, and I think has let a little bit of air out of the tires, has really just been what we've seen on the drilling rig and frac crew counts, where they've essentially flatlined month over month in May over June. I think the baseline expectation was continued increases in rig counts in a somewhat linear fashion. I'd say that was the consensus view. We expected rig count might take a pause just given how far and fast it had run, only to rally in the back half of the year, but we were count us in the surprised camp on the completion side of the frac spread count. So there are kind of a few arguments around what undergirds the flat completion side of the equation in May and June. Number one, completion services players fracked or completed wells faster and more efficiently than expected as things like simul-fracs, frac efficiencies, more prevalent use of e-frac and dual fuel, which is allegedly adding some efficiencies in certain cases out in the field, kicked in and just led to pressure pumpers out kicking their coverage. And E&Ps just said, slow down. We're trying not to grow. You guys have gone too fast. The other is, labor tightness, gross pricing power, some inflationary pressures have kicked in. And E&Ps look to mitigate this cost creep by slowing down the pace of fracking wells with the belief that the pause will alleviate some of the stress in the system. We'll be able to get people in working on those frac spreads. And when someone calls, company X and asks for a pressure pumping spread, that pressure pumper can get you that fleet pretty quickly. Typically what you see is if labor inflation kicks in, even if we look oversupplied from an equipment standpoint, pricing power kicks in faster than that supply demand picture might indicate it should on the equipment side. So you hit the pause button, you can see that OFS companies are hiring, you can see it on Twitter, you can see it on LinkedIn, you can see it from job posts. So allow them to get the people, and then there may not be as much pricing pressure in the system. Historically, E&Ps have just kept blowing and going, but this may just speak to some capital discipline on their side. Either way, we do believe more U.S. frac spreads and drilling rigs need to go to work in the second half of 21 if the U.S. is going to grow production in the low to mid-single digits in 2022. So we expect the pause will prove ephemeral. And then just shift into the international side. The international scene is probably where we see the greater rate of change in activity in the second half and during 2022. The nascent recovery in international markets has really only just begun. International activity tends to drift down more slowly, the North American activity, and international activity tends to rise more slowly. So, America took North America took the torch and kind of carried it initially, getting us out of the dumps, but the international markets are about to carry that torch for the remainder of this year and in 2022. The global supply chain remains a bit of a pain, but companies are figuring out how to matador around the majority of these issues, and the back half of 2021 looks brighter than the first half of the year. So I do kind of like the setup here after this fade, and if the fade continues in the OFS equities, there are a number of high-quality names that we would actually advocate buying as we press into the back half of 2021. If there are no questions there, I'll shift to solar. All right, hearing none. Solar, so right now we're focused on the residential solar sector. Some of the companies we cover do have exposure to the commercial and industrial end markets, but not much utility solar in our coverage at the moment. And I ended with supply chain for OFS, so it's a good segue into solar. The topic du jour is the global supply chain. Much like there have been pain points on the auto side, a lot of that's bled over into the solar space, especially for the manufacturers of solar equipment who are heavily dependent on metals and minerals and moving big pieces of equipment around the globe. So we saw the solar equities get punished as the global supply chain issues associated with semiconductors, chips, the potential U.S. regulatory sanctions against the miners of polysilicon across the pond over in China. Steel and other items dented guidance, and or some people have been able to matador around these issues by paying higher expedite logistics costs. But those expedite logistics costs have surged and dented companies' profitability. So despite the fact that these issues likely prove transitory, that just kicked a bunch of these solar stocks in the teeth, and they got beaten up pretty hard. The other important topic the guys are keyed in on, which kind of surprised us when guys got all been out of shape about it, was investors are very fixated on battery sales or energy storage sales associated with solar panels, residential solar panels. Surprised us because it's a very small portion of the market today. We understand that the growth is extremely important for these equities long term. But just to frame it, we think about less than 5% of residential solar systems had batteries on them in the 2020 timeframe. It's a very small part of the market in the nascent stages of growth there. The Tesla Powerwall gets a lot of fanfare, but it just isn't that meaningful as of yet. Well, it appears that the battery sales rates are on the upswing. There looks to be a light at the end of the tunnel concerning the supply chain woes that we had seen. So both of these issues that we viewed as transitory seem like they're proving to be transitory. Doesn't look to us like that light at the end of the tunnel is a train, but actually an exit from this dreary supply chain kerfuffle. So the stocks have rallied really hard and really sharply off their lows. And then, from an outlook perspective, what really matters is, are we still seeing the continued appetite for residential solar from folks? And the great news there is, from a bigger picture perspective, it seems that demand for solar remains very strong, with orders growing quite nicely, and it's the supply chain constraints that are limiting sales, but those are abating. The attachment rates are picking up from a battery perspective, and some people who had a solar system without a battery are deciding that they want to add a battery to it. So it's not just new systems where those sales are occurring. And so because of that, we officially modeled when we launched on the space 7% residential solar penetration, and kind of called our upside case 10% residential solar penetration, 10% by the end of the decade. So officially 7%, 10% is an upside case. if we end up, over 7%, there's material upside to the solar stocks, even versus our above current, our price targets, which sit above current share prices. So if we end up at 10% plus, that's just a very meaningful change. And, we would argue that there's super fetching upside for many of these solar equities if we get to north of 10%. So the demand picture remains healthy. The issues that people are focused on are transitory in our view, and there's still upside to these equities.
Well, we've also now exposed you, George, as the vocabulary king here at TPH Research. Ephemeral, kerfluffle, matador. I mean, parents could tune into you and improve their kids' SAT scores. It's fantastic, not to mention the research coverage.
When you've been writing equity research for 12 years, one of the things that gets the most boring is using the same words over and over again. So I came into the business of vocabulary dunce, and boredom is what's forced me to get better at it, but still working on it.
But isn't it fascinating? Here in the U.S., we're talking about, I saw a story about a $1,200 signing bonus if you'll go to work at Burger King. And the Chinese labor stories are slave labor, potentially accusations in the manufacture of solar panels. It's a little different.
It's a very different world. And that very interesting thing was peeling back the onion there. It seems like the sanctions that are being envisioned to be put on these Chinese manufacturers, which you're really putting sanctions on, is the miner. But where they'll do the customs checks is at the border, once that polysilicon's already been converted into the wafer and put on a panel. So actually tracking that back to the miner is going to be extremely difficult. And it seems like most of this stuff's still going to ship, and it's kind of saber rattling with no teeth rather than real sanctions that are going to limit the exports of the polysilicon, because you don't really sell raw polysilicon across the pond.
Well, I've just noticed our friend Michael Schellenberger has been doing some interesting comments on it, talking about nuclear. And so anyway, we could go all day on that issue. Thank you so much, George. Okay, Matthew Blair, you are the closer. You're the fourth Matt. This is a 4-Matt show today. We just love guys named Matt here at TPH. Matt, why don't you take it away and bring us home?
Yeah, thanks, Maynard. There's too many Matts here, but I'll be talking about refiners, chems, and renewable diesel. For refiners, group had an excellent first half of the year. It surged 46% in H1. Part of that was due to investors really just playing the overall recovery trade, but part of it was also due to an improvement in fundamentals. So earnings estimates generally moved higher for both 2021, especially 2022, and that was mostly due to a strong product futures curves. Looking out to the back half of the year, we do see some additional tailwinds on profitability. So trends on air traffic have been very encouraging. For example, TSA passengers are currently at 81% of 2019 levels. To start the year, that was only 35%. So this should boost jet demand, which will tighten the overall distillates market. That'll lend support to both jet cracks as well as diesel cracks. And then 2, we are expecting some RIN relief for refiners when the EPA sets the RVO in July. The current headwind to benchmark cracks is over $8 a barrel. Last year, it was $2.50 a barrel. So that should provide some pretty meaningful relief for refiners. I would say, though, investors are negative on the group due to valuation. If you take, say, like a high-quality name like Valero, based on consensus, it's trading at 6.4 times on 2022 EBITDA. From 2017 to 2019, this stock traded at an average forward multiple of 6.6. So investors feel like we're in the 7th, 8th inning of the recovery trade here. They just don't see that much upside going forward. On the chem side, group had a solid first half of the year. It was up 18%, basically as blowout earnings were offset by multiple contraction. The blowout earnings were a function of faster than expected demand recovery, with areas like construction, autos, and packaging really coming back strong. And then we coupled that with some key supply shortages. And so that was exacerbated by significant U.S. capacity. At one point, every cracker in Texas was down due to Winter Storm Uri. So to give you some examples here, PE prices have eased a little bit but they're still at 80 cents a pound. The 5-year average here is 47 cents a pound. PVC prices have come down too, but they're holding in at about 66 cents a pound, and that compares to a 5-year average of 37 cents a pound. Looking into the back half of the year, we're constructive on a few themes in the space. So one, we continue to like these change stories where you've either had a new management team come in or you've had a big portfolio shift through M&A. And the market simply has been a little slow to recognize those stories. So names like Olin and Huntsman fit the bill there. And then we continue like stocks with financial flexibility and good balance sheets. That's really opened the doors to some attractive M&A as well as increasing capital returns. And so stocks like Celanese and Westlake are our favorites in that space. And then finally wrapping it up with renewable diesel. So the group off to kind of a sluggish start in the first half of the year, down 2%. Keep in mind this group did move up 120% in 2020. Earnings have been better than expected in the first half of the year, especially for advantaged feeds. So these are feeds like used cooking oil or white grease or tallow. And keep in mind that the companies that we cover tend to have anywhere from 75% to 100% advantage feed share. In the back half of 2021, the biggest moving part is this upcoming RVO from the EPA. So RVO stands for Renewable Volume Obligation. There's been a couple of signals from the Biden administration that they are looking to ease up on this RVO. So that means potentially less ethanol, potentially less renewable diesel, less biodiesel blended in to the overall transportation fuel pool. Biden administration is concerned about refinery jobs, union jobs at some marginal plants in the Northeast, as well as just overall gasoline prices. We're currently at new 5-year highs on gasoline prices. So we do expect this RVO to be headline negative for the group. It's a political risk that is keeping investors on the sidelines for now, but it should open up some interesting entry points for some high quality names. So with that, Maynard, I'll turn it back to you.
Wow, that was fantastic. Well, let me just wrap up because we've covered so much territory today. But I think for those of you watching at home, you just see how the world has changed. Our Upstream analyst is also covering automobiles and electric vehicles. Our oilfield service research analyst is now added in solar. You saw it as we went around. Matt's added renewable diesel, renewable natural gas. So it's a big blended hybrid world that we're all living in. And as one of our young people said to me today, it's never been more fascinating to be in energy. So let me just wrap up by saying thanks. We hope everybody enjoyed it, and we'll look forward to doing it again, at least at the end of this half of the year. So thanks, everybody. Take care.